Something massive just happened, and if you are anywhere near the age of 73, you need to stop whatever you are doing and pay close attention to the next few minutes, because what I am about to share with you could either save you thousands of dollars or cost you a penalty so large it will leave you absolutely speechless. The IRS has updated several key rules surrounding retirement account withdrawals for 2026, and millions of seniors across America have no idea that a ticking clock's already counting down on their savings. These rules are buried in IRS code language that most ordinary people never read. Financial advisors do not always bring it up unless you ask the right questions, and the penalty for getting this wrong is not a slap on the wrist. We are talking about a tax hit that can devour up to 25% of the amount you are supposed to withdraw. So today, I'm going to walk you through exactly which 5 types of accounts are affected, what the updated 2026 rules say, who qualifies, what the deadlines are, and most importantly, what you need to do right now to protect yourself. Stay with me through this entire video because around the middle, I'm going to reveal the single most overlooked account on this list, one that shocks almost every senior I talk to. And at the end, I will give you a step-by-step action plan you can start using today. The rule at the center of all of this is called the Required Minimum Distribution, or RMD. This is the government's way of saying, you have enjoyed tax-deferred growth on your retirement savings long enough. Now it is time to start withdrawing money and paying taxes on it. For decades, the age at which these withdrawals became mandatory was 70 and a half. Then Congress changed it to 72. Then the Secure 2.0 Act pushed it again to 73 for anyone born between 1951 and 1959. And for those born in 1960 or later, the age is now 75. When you delay withdrawals, the money in your accounts keeps growing. And when you finally do have to start taking those required minimum distributions, the amounts can be shockingly large. That pushes you into a higher tax bracket. It can cause more of your Social Security income to become taxable. It can even trigger something called IRMAA, which stands for Income-Related Monthly Adjustment Amount. And that means you will pay significantly higher Medicare premiums. So what looks like a gift of extra time actually becomes a financial avalanche if you are not prepared. The first account on our list is the traditional IRA, and this is the one most seniors are at least somewhat familiar with. If you have a traditional IRA and you turn 73 this year, or have already passed that age, you are required to take a minimum distribution by December 31st of each year. The only exception is your very first RMD, which you can delay until April 1st of the following year. But here is the critical warning. If you delay that first withdrawal to April of the following year, you will then be required to take 2 distributions in that same year, one for the previous year and one for the current year. That double withdrawal can spike your taxable income dramatically and create exactly the kind of tax mess we're trying to help you avoid. The IRS calculates how much you must withdraw each year using a formula based on your account balance from December 31st of the prior year, divided by a life expectancy factor published in IRS tables. The updated 2026 tables reflect slightly longer life expectancies, which does reduce your required withdrawal amounts a small amount, but do not let that lull you into thinking you can skip it. The penalty for failing to take your RMD is now 25% of the amount you should have withdrawn. That penalty was reduced from 50% by Secure 2.0, and it can be further reduced to 10% if you correct the mistake within 2 years. But even 10% is a painful and completely avoidable loss. The second account you need to know about is the traditional 401k. Many retirees think that once they leave a job, they can just leave their 401k sitting where it is indefinitely. That is simply not true. Once you reach age 73, your 401k is subject to the same required minimum distribution rules as your traditional IRA, with one notable exception. If you are still actively working for the employer who sponsors the 401k, you may be able to delay RMDs from that specific plan until you actually retire. But here is where people get into serious trouble. If you have old 401k plans from previous employers sitting around, those are absolutely subject to RMDs right now, regardless of whether you are still working somewhere else. I have spoken with so many seniors who completely forgot they had an old 401k from a job they left 15 or 20 years ago, and suddenly they are hit with penalties they never anticipated. go through your records today. If you have any old employer retirement plans, find out their current balances, contact the plan administrator, and make sure your RMDs are being calculated and taken correctly. If this video is already helping you understand something you did not fully know before, please take a second to give it a like and subscribe to this channel. We publish information like this regularly, specifically designed to help seniors and retirees navigate the constantly changing landscape of taxes, benefits, and government rules. Subscribing is completely free, and it ensures you never miss an update that could affect your financial future. Now let us keep going, because the next 3 accounts on this list are where things get really interesting, and one of them might genuinely surprise you. The third account is the SEP-IRA, which stands for Simplified Employee Pension, IRA. This type of account was extremely popular among self-employed individuals, freelancers, small business owners, and independent contractors. If you spent any part of your career working for yourself, there is a very good chance you contributed to one of these. The rules for SEP-IRAs are identical to traditional IRAs when it comes to required minimum distributions. Once you reach age 73, withdrawals are mandatory, and they are calculated the same way using your prior year-end balance and the IRS life expectancy tables. What makes SEP-IRAs particularly dangerous is that they often have very large balances because the contribution limits were historically much higher than a standard IRA. That means when RMDs kick in, the dollar amounts can be substantial, and the tax impact can be significant. If you have a SEP-IRA you have not thought about in a while, now is the time to pull it back to the front of your financial planning. The fourth account is the Simple IRA, which stands for Savings Incentive Match Plan for employees. These were offered primarily by small businesses as an alternative to a 401k, and millions of American workers contributed to them throughout their careers. Simple IRAs follow the same RMD rules as traditional IRAs and SEP IRAs. Once you hit 73, the clock is running. What makes simple IRAs tricky is that many people do not even remember having them, or they assume the account was closed when they left the employer. That is not always the case. The account may still exist, may still be holding assets, and may be quietly generating an RMD obligation that you are completely unaware of. The IRS does not send you a reminder letter. Now here is the fifth account, and this is the one I promised would surprise you. Most people have never heard it discussed in this context, and yet it affects a growing number of retirees every single year. That account is an inherited IRA, also called a beneficiary IRA. If you inherited a retirement account from a spouse, a parent, a sibling, or any other person, you may have a required minimum distribution obligation that is completely separate from your own retirement accounts. The rules surrounding inherited IRAs were significantly changed by the original Secure Act in 2019 and then further modified by Secure 2.0. For most non-spouse beneficiaries who inherited after 2019, the IRS now requires the entire account to be depleted within 10 years of the original account owner's death. But here is where it gets complicated. The IRS spent years issuing confusing guidance about whether annual distributions were required during those 10 years or whether you could simply wait and take everything in year 10. In 2024, the IRS issued final regulations clarifying that if the original account owner had already begun taking RMDs before they passed away, then the beneficiary must also take annual distributions during the 10-year period. Failing to comply with these inherited IRA rules can trigger the same 25% penalty that applies to regular RMDs. Now let us talk about Social Security, because this is where RMDs create a second layer of financial pain that most seniors do not anticipate. Your Social Security benefits may not be entirely tax-free. In fact, depending on your total income, up to 85% of your Social Security benefits can become subject to federal income tax. The threshold that determines how much of your benefit is taxable is called your combined income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. When your RMDs push that number above certain limits, which are $25,000 for single filers and $32,000 for married couples filing jointly, more and more of your Social Security income becomes taxable. These thresholds have not been adjusted for inflation in decades, which means they catch more seniors in their net every single year. Your RMDs are not just affecting your retirement account taxes, they are potentially making your Social Security more expensive too. If your income climbs above a certain level because of large RMDs, you can be hit with IRMAA, surcharges that increase your Medicare Part B and Part D premiums by hundreds or even thousands of dollars per year. For 2026, the IRMAA surcharges kick in at $106,000 for individuals and $212,000 for married couples filing jointly. These are not hypothetical numbers for wealthy retirees only. If you have spent decades saving diligently in tax-deferred accounts, a few large RMDs can absolutely push you into IRMAA territory. And the particularly frustrating part is that IRMAA is calculated based on your income from 2 years prior. So a large RMD this year could raise your Medicare premiums in 2028 before you even see the connection. The first is Roth conversions. By converting money from your traditional IRA to a Roth IRA before age 73, you reduce the balance that will be subject to RMDs later. Roth IRAs have no required minimum distributions for the original owner. You pay taxes now, but you protect yourself from a much larger tax burden later. The second strategy is qualified charitable distributions, or QCDs. If you are 70 and a half or older, you can donate up to $105,000 directly from your IR to a qualifying charity, and that amount counts toward your RMD without being included in your taxable income. This is one of the most powerful and underutilized tax tools available to seniors. The third strategy is careful withdrawal timing and tax bracket management. Working with a financial planner or tax advisor, you can spread your RMDs in a way that keeps you in a lower tax bracket and below IRMAA thresholds. The deadline you absolutely must remember is December 31st of each year for ongoing RMDs. Your very first RMD can be taken as late as April 1st of the year after you turn 73. But as we discussed, doing so creates a 2-distribution year with serious tax consequences. The smarter move for most people is to take that first distribution before December 31st of the year they actually turn 73, to avoid the double hit the following year. Each account must be treated separately for calculation purposes. However, if you have multiple traditional IRAs, you can combine the total RMD amount and take it from whichever IRA you choose. That flexibility does not apply to 401k accounts, which must each satisfy their own RMD independently. The IRS has significantly increased its enforcement of RMD rules in recent years. Automated systems now flag accounts where distributions appear to be missing or insufficient. The days of this slipping through the cracks are over. The IRS knows what is in your accounts, and they know what you should be withdrawing. The best protection you have is knowledge, preparation, and action. If you have new on this channel, please subscribe for our support. Tell me where you're watching this video from.